Hey guys, my first of the year video here. Basically, we all know that the markets are toppy and they can continue to get even more toppy. Some themes I'm looking at here is a first quarter uh, or a fourth quarter uh, run up. Well, yeah, from Christmas holiday season run up in the markets. That's kind of what I'm getting at here. And basically, I'm watching this two standard deviation. I have a 50-day moving average on my Bollinger Band. Okay, and I'm watching this two standard deviation on the Bollinger Band as a run up potential into the first of the year. And basically, I'm thinking we're going to run up. The next couple weeks we're going to be running up in the markets into earnings season that starts late January, early February. And basically, our two standard deviation is way up here near this line, the 3920 area. So that's a theory that I'm putting out there. Basically, we've been channeling here, and as of Friday, got the short squeeze, preparing to break up in the higher range of the channel, which we've been channeling in. Thinking here going into the 1st of February, we're going to be close to 4,000 on the ESs going into that, hugging, getting awful close to this two standard deviation move on the ESs. So if I can, I can't get it to do it right. Auto zoom. Any other time I could do this. Okay, there you go. So basically, our two standard deviation is coming right into that $4,000 area on the ESs. So definitely something that I'm keeping an eye on, the 3,900 to 2,000, 4,000 area on the ES futures. Okay. Well, shoot, I don't think it recorded. Okay, our NQs all of 2020 have just been outrageous. The tech sector has just been on fire. I do think right here at the first of the January we're going to see a resumption in the accelerated uptrend in the NQs, and I am projecting a price target into the end of January on the NQs all the way up to the 14,800 area. So that would be basically a 1,200 point move higher on the NQs going into earnings season with online retail stocks leading the way, in my opinion. So this is a theme that I am putting out there. I think in January you're going to see the NQs outperform the other sectors, in my opinion. Okay, the Russell. Some themes that I'm looking at on here. We're hugging this two standard deviation move, and this is also an alpha sector on our small caps. But the big issue I've got with this is still the COVID issues. That's my biggest concern here. So I'm thinking this is going to be strong, but not nearly as strong as the Nasdaq. So just keep that one in mind here. Some things I'm looking at here: the 2,240 area going into the end of January. Um, so basically, somewhere I expect it to be higher, but yet I'm not for sure just how much higher. You know what I mean? With the COVID issues possibly exploding into January. So that is a theme that I'm looking at here going forward. Second place behind the Nasdaq, I'm expecting the Dow to outperform going into the end of January, as we will probably take a run up to the into earnings season for the two standard deviation move off the 50. Let me see if I can get this going here. As you can see, we are well below that right here. Let me try to get it zoomed properly here and give you an idea of some price targets here. So if my theory is correct, we're probably looking at close to 32,000 on the Dow going into the end of January. So I'd be a 1,500 point move higher on the Dow going into the end of the year. So basically, my first place NASDAQ, I'm expecting massive upside. And a lot of the Dow components now are also tech driven. So your Apple, your Intel, and the like driving forces for this. And we do have a major upgrade on Caterpillar as well, so our industrials are likely to also get a bid. And we always have Boeing that can be the outlier, getting a nice because it is relatively undervalued on a price to earnings basis. Okay, it's cheap because of the COVID news, but it's still relatively cheap versus the rest of the market on Boeing. So those are things that I'm looking at here going forward into the first of the year. Some themes I'm looking at for earnings season: uh, hardware, computer technology. I think is going to be a major outperformer this year. For example, I had a Chromebook I bought last year for Christmas from my niece or nephew, and their parents ended up buying them something, so I held on to it to this year. I gave $120 for this Chromebook last year, and you couldn't even touch the same Chromebook for under $400 this year. So I do think there is major pricing power in the laptop and PC uh, realms of the market. And this is one area I think is going to have an explosive move higher onto into earnings. So I am actually projecting, like just like with Dell, that we are going to have a price close to $95. Uh, at or into or after earnings. Okay, earnings we do report February 22nd. Well, the projected earnings date is February 25. So we'll see. We'll see what's going on there on Dell. Another one's HP. I think these things are going to just completely explode to the upside. Breakouts. So we've had a multi-year consolidation all the way back to 2007. And I do think we're due for a major breakout in HP. We could be looking at $50 a share on this one when these earnings start hitting the tape, in my opinion. So this is some things that I'm looking at here. Legacy Tech really being a bit big this year. Lexmark, let's see, LXQ, isn't it? LXQ, is that right? No. 1 second here. Let me find Lexmark for you. Another one, Lexmark. Look how cheap this thing is relative to the rest of the markets. I do think this is an explosive setup for earnings season, potentially all the way up in the 70s going into earnings season, maybe even more. I do think it's going to be a very big year for computer hardware and computer peripherals. So definitely something to think about going into this earnings season, in my opinion. Another thing that I'm looking at here, and that's Netflix for an earnings season run up. Now, why is that? We saw right there at the end of December, the first thing they were going into was Netflix for technology for 2021. We saw that Thursday night or Thursday afternoon, them starting to add, and we had a very good day Friday on Netflix. So this is one I'm definitely keeping on watch, going for an earnings run up um, into January here. So definitely something to keep on watch. Some things I'm looking at here. A real quick move all the way up back to all time highs, probably this week. Quite possibly this week. When this thing gets going, it goes fast. Okay, so just keep that in mind. So 575 potential very soon here. Earnings are on the 19th, so we've only got a little over 2 weeks for a earnings run up here. So we do have a limited, but I do think we're going to be up here near all time highs for the earnings season run up on Netflix. And the main reason I like Netflix long is for the earnings run up scenario is because of the higher, uh, they raise their prices. So typically they do every quarter that they've had price increases that you have seen an earnings run up into earnings. Now they might sell off on earnings. I totally agree, and I do think the price multiple for Netflix is not justified for their growth metrics. Okay, what I would like to see out of Netflix is more diversity in their revenue stream. Like they're, for one thing, one key thing, they're making these high theater quality shows on Netflix, and they're having these high profile actors coming in, like Sandra Bullock, and they had George Clooney was the latest one, and then we even had Queen's Gambit. These are really theater quality productions. I think they need to break those off into a premiere service where you're paying $4 or $5 a month for very exclusive content, either that way or have a like a traditional model, $20 for so many hours, like 48-hour viewer ability to view it for 48 hours for like $20 or something like that. This new content, diversifying their revenue stream. The main reason I say their original content needs to be diversified because they do not have brand recognition for their legacy assets. They're spending millions of dollars on this content, but because they're giving it all away for the average for every consumer, they cannot sell their content to ABC, CW, or any of these other networks at a premium. They're having to sell this content at a discount to these secondary uh, services. And the legacy asset revenue is very important to the sustainability of a uh, for companies. And Netflix, they do have a serious brand issue when you have Disney and Apple coming right in and cutting them off right at the knees here, because their content is going to be premium content. And even CBS realized that their content was at a premium, and they are isolating it in such a way to where they can get those higher price multiples on the secondary market, and they can sell it and get paid back for their investment at a higher price multiple. So that is definitely something I would like to see out of Netflix, and then also possibly an additional side service or something, to where they're breaking off the Netflix platform into separate service in one or two separate services, uh, to where they can, have a whole different group of people uh, signing on because they want to have this type of content over here, and a fee. Uh, so basically, trying to get customers to have multiple Netflix services, and pay for different, you know, content, instead of having all one carte blanche under one fee. So that is something that I would really like to see happen with Netflix to really sustain these high price multiples. So basically, I'm just short term bullish Netflix, but long term, I think it's stagnant management, and they definitely need to change the way they're doing things to maintain these high price multiples with them facing such new competition in video streaming. Okay, Facebook is one you really have to be careful about here because we are coming off a very overbought situation in Facebook. So we are outside the two standard deviation, have been for a while here, and we kind of stagnating out here. And so I'm definitely keeping this one on watch. Where's that line at? So basically, that's our two standard deviation line right here. We came outside of it, and we've been digesting here. So basically, if we do have the run up in earnings, like I suggest, we will probably soon see a move up to 315 on Facebook. One thing that I definitely want to see out of Facebook, because they have the platform to do it, I want them to start a video streaming business. I want them to be one of the late entrants here, and them also entering video streaming on their platform. And I think that will justify higher price multiples if they announce that they are going to start creating their own content and enter video streaming on their platform. And I think they should have already been doing it, to be honest. But I do think that will drive so much traffic to their platform. And the good thing about that, you can like, you know, I just think it's a perfect fit for Facebook to have video streaming on their platform. So that's something I'm looking for to happen here in the not so distant future. Another one, your semiconductors. We are in accelerated growth phase on our semiconductors, and I do not think it's going to slow down at all in January. So this is one definitely that I'm looking at here for January here at we are at 221 area. I'm thinking the 240, 250 area going into the end of January, to be honest. I do think we're going to get a nice little bit in our semiconductors going into this earnings season. So keep that one in mind going forward here. One of the biggest risks I see going forward here, that's your biotechs. We did have some major selling in the biotechs last week. So just remember that going forward here. Um, we will see here how far it can come in here. But the news was bad. The news flow was bad about how many people had actually been getting the vaccine. But expectations are through the roof for the biotechs. So I think this is the one we have to be worried about going into earnings season, as people start to think that expectations may be too high going into earnings season for a lot of these biotechs that are dealing with the COVID vaccine. So definitely something to think about here as potential pullback going into earnings season, and with a possible upside surprise after the numbers are released. But remember, we are dealing with quite possibly the second biggest stimulus ever in U.S. history. So by far, this is going to be very bullish for at least the first half or so of the markets. And we're probably, if anything, we're going to see even less earnings guidance going into the first half of the year. And I do not see any type of company coming out reissuing guidance until we're through the guts of this crisis. So it'll be late 2021 at the earliest, in my opinion, before we start seeing a resurgence of earnings guidance. And given the high price multiples that these stocks are currently giving, I just don't see a big hurry for companies to start reissuing guidance, to be honest, because they do love these high price multiples by not giving the guidance. So just a few things I'm looking at here in the markets. Let's see here. A final area which has been left for dead, and that's your XLE, your energy sector. That is one area that I do think we are preparing to get a nice little bid into spring in our XLE. I don't know if it's going to happen in January because we're at the height of the crisis, but I'm watching this. You see how we've been in this downward trend, this 2 standard deviation sell off on well, it's a 2 standard deviation down here. I'm sorry. That's our 50-day moving average, descending 50-day moving average. So basically, we're right here, right now, trying to get some traction to the upside. And so far, we're still in a downtrend, but it looks like that we found a bottom, and we're probably going to digest sideways for a time, and possibly reverse here going into spring on our XLE here. So that's one area I'm definitely keeping a close eye on, is our energy space because of that. And then also our airlines, as we get through the heart of this sell-off, our airlines finally, because they are getting a lot of government dollars to keep going, and this is free money for the airlines to keep their operations going here. So I do think also in our airlines, and if you go, is it TRAN? I think, yeah, TRAN, NASDAQ Transportation Index, that pretty much tracks the airlines. And as you can see here, we are at right up here near all-time highs on the airlines in the face of, um, horrible pandemic. And it's, that's probably setting up for a breakout with the new government dollars coming into the transports. So valuations are very high, especially given the uh, situation. You only got 50% of the flights being filled right now. Is it justified to be this high? I don't know, but they are getting more government dollars put prices even higher. So, up to the 2 standard deviation, you're looking almost 6,000 on the Nasdaq. So that's almost over about a 500 point increase, uh, potentially here for before you get to the overvalued point. So something to definitely think about going forward here in your trading. So that's some ideas that I'm looking at here. Yeah, as you can tell, I'm very bullish. When you have a stimulus of this magnitude, shorts tend to get run over. So be careful if you are trying to short this market, in my opinion. Okay. Thanks a lot. Like the video if you like it, and please leave comments. Stuff you're expecting this year. I'd like to hear from you. A lot of times the comments will give me some great ideas for the year. So if you got some ideas about what's going to happen this year, I'm happy to have that added to the bottom of my YouTube. Thanks a lot.